Hello and welcome back to the course. Without a doubt, the most common fatal mistake is being undercapitalized, and that's what I'm going to talk about in this quick video. Being undercapitalized is especially common as people are looking to get into trading to become rich overnight, unfortunately. There are two types of traders in the long run, those who love trading and those who look at it as a slot machine of sorts. Unfortunately, most of us get involved in the Forex or even trading markets because we have watched some type of video or seen a website or something, promising possibility of returns of like 500% in a week, which we never seem to do the math. Just simply doubling your money every week. After a few years, you would eventually have all the money in the world if you start trading like that. Most people only focus on the potential gains. They don't realize that being undercapitalized puts you at risk especially in leveraged markets, because the market can and will move against you. You will have losses, and those losses will be devastating. This is especially true in some other markets. Forex is a little interesting because you can take extraordinarily small positions and lever them up. So you may, depending on what country you're in, you may be able to have as much as 1,000 to 1 leverage. So most professional trading firms do not allow their traders to lever up more than 10 to 1, and even that is a bit extraordinary. With that in mind, your average trader, for every $1,000 that he or she has to trade on the trading desk, really can only take on anywhere from about 6,000 to 10,000 in currency, which is nothing compared to what most retail traders will do. They get whipsawed very quickly because the losses pile up and margin calls ensue. And also, quite often they take trades in contracts they have no business being involved in. So here we go. This is crude oil. Now, this is the futures contract, but you can see that depending on which one of the versions, it's basically 2,000 to 2,300 in margin. Well, at $10 a tick, it doesn't take much to suddenly find yourself, down $2,500. And if you have a $2,500 account, that's it. You're done. And that's something you have to keep in mind. With, other markets like Forex, you can dial down the position size, but most traders don't do that. What they do is they take $1,000 and try to turn it into $1 million, not recognizing the fact that when trades go against them, it wipes out horrific amounts of their account. Being capitalized means that you can ride out the volatility and take the fluctuations that happen in the market. If you are not, and you're literally inches from disaster on every trade, it's only a matter of time before you give it back.